Hello, good morning, good afternoon, good evening, wherever you are located in the country. Thank you for watching. We have some very good, exciting presentation for you. My name is Seewing Yi from the Yi Real Estate Network, and I am my company. We specialize in helping investors, out-of-state investors, to buy out-of-state turnkey passive real estate investing, mainly single-family home and duplex, sometimes up into fourplex, and we've been doing it for a very long time. And we surround ourselves with different markets in the country, mainly in the South and Southeast. And we partner ourselves with many market providers, turnkey market providers in a specific market. And today, our guest host is Mr. Justin Zawatny from Southwest Florida, Cape Coral area. And welcome, Justin.
Thank you. Thanks for having me.
Yeah, appreciate you coming on board. And we've been working together for several years. And we have some very good success of our investors, mainly from California, have achieved very good success buying turnkey cash flow properties in Cape Coral, Southwest Florida market. So without further ado, let me go, allow me to share several of my slideshow to give you my perspective about the Southwest Florida market. And then when I get done, then Justin will have his own PowerPoint presentation, and he will update investors out there what's going on with the market right now as we move into the summer of 2022 and beyond. So very exciting. So without further ado, let me share my screen. And here we go. So first and foremost, I always start from now on, I will always start my presentation with this nice high-level 10,000 square foot, a high-level foot overview of real estate investing. Income property, rental property is history's most powerful and proven and tax deferral, tax efficient, multi-dimensional real estate asset class. And it's all about, it's not only about positive cash flow. Yes, positive cash flow is one component. Tax benefits is a second component, and long-term equity appreciation is the third component. And then appreciation, same category. And leverage, the power of using leverage is so critical, and because you are using a mortgage loan, a 30-year fixed rate loan, to leverage your investments and achieve a lot more. And then now we're gonna use this sample, a real case study. Okay, so with that in mind, I say it again, there's no asset class, not Bitcoin, not crypto, not the stock market, not mutual funds, that are come even close to income property and the ability to generate so many facets of profit-making opportunity. So with that said, let me use a real case study. This property located in Cape Coral is single-family home, new construction, 3-bedroom, 2-bath, around $385K. Now, so really, I mean, given the in conditions, what's going on in the country with a higher interest rate, and there's a lot of challenges out there, right? I mean, but at the same time, my recommendation is that nothing wrong with buying the properties right now for real estate investors, because if you have the 25% down payment, if you can think long term, right? And then there's nothing wrong to buy an investment property at this point, as long as you buy in a good market and surround yourself with a good turnkey provider such as Justin. So with that in mind, even at today's 6% interest rate, yes, even a 6% 30-year fixed rate for real estate investors, you can still do well. So for example, you pull the trigger right now, you buy this property, put down 25% down payment, your total out of pocket is around 100,000, and then you get this property rented, fairly quickly, fairly easily in this market for $2,500. So I'll quickly come to the point. And then at the end of each month, your gross rent of $2,500 minus your monthly mortgage at 6% which is approximately $1,550, and minus your vacancy factor or a couple of percent, your monthly property taxes, insurance, and property management fee equal your monthly net cash flow of approximately $187. Now, I know what you guys are thinking. Oh, the cash flow is too low. I'm putting 100 grand out of pocket. What am I going to return? Most investors over the years, they put too much focus on positive cash flow. This is just one component of a multi-dimensional real estate asset class, as I stated to you earlier. So do not worry about that, because you're buying for the long term. So when you buy for the long term, I'm not going to go through this 10-year projection in detail, it'll take too long, but you will see the big picture. From year to year, if you have the ability to project rental increases to the tune of 5% rental increase year over year for the next 10 years and beyond, you will see more positive cash flow, right? And then your expenses, are pretty moderate. And then the beauty of it, from year to year, as you can see, the other projections, then you're going to have annual appreciation, right? I projected around 6% year over year annual appreciation. I know nobody can predict the future. You can see the systematic growth of this rental property, right? So it grows from 385 to 408, then all the way to year 10 to quite substantial. The year 10 is around $689,000. Meanwhile, your renter, your poor renter, they're going to make you rich, because that rent will pay down your 30-year fixed rate mortgage, right? That's amazing. And then when you increase your market value from year over year and your loan balance gets decreased year over year, then you have more equity. Your equity grow, right? Compoundly from year to year. And then at some point in time, in the third, fourth, and fifth or seventh year, you have enough loan to value to potentially cash out refinance equity to leverage to buy more rental properties. That's how rich people will create their wealth over time, by getting the equity growth, potentially cash out refinance to buy more properties. And then on the last category, as you can see, investors over the next 10 years or more, they could sell the property or pay the capital gain. They could do a 1031 tax deferred exchange and not pay capital gains taxes, and so forth and so on. So there's a lot of multiple exit strategies available out there. So at the end of the day, it's not all about cash flow. Investors, in the past, yes, you're getting more cash flow in the past, but now you have to be more realistic these days. And then finally, again, this 30-year fixed rate mortgage is amazing, right? I mean, is amazing. Is inflation-induced debt destruction. Then now we all been hearing that, because right now we're at a 40-year low in terms of home affordability based on skyrocketing housing prices in the past few years, and so a lot of homeowners, potential homeowners, they cannot afford to buy, so they are renting because of inflation, because of lack of homes to buy and lack of homes to rent. The landlords all over the country has been raising their rents. It's all out there. Skyrocketing rents is going on. So the wise investor, right? You need to avoid all the doom and gloom out there, right? All the negative headlines and what have you. Buy in a good market with a slight positive cash flow. You buy even at an interest rate of plus and minus 6%, right? Because you're still getting a little bit of cash flow, and then for the next few years, enjoy the potential equity appreciation, right? And then with your accumulation of your small monthly cash flow, and then have the renter continue to pay down the principal, right? And then you can get a lot of tax benefits, which we don't have time to talk about. So you'll have a slight positive cash flow, and hopefully the interest rate is going to come down at some point in time. May not be this year, may not be next year. Based on what I've heard, maybe 2 years from now, 2 or 3 years from now, interest rate is going to stabilize. It's going to come down to 4.5 or 5%. Then, because as a real estate investor, you have the ability to adapt, and we believe the skyrocketing of rents, you may not see the impact of the higher rent, at least not right now, but gradually in about 2 to 4 years, the double-digit in rental rates increases, depending on what market, of course. In 2 to 4 years, the lagging rental rates will catch up, right? So what I'm trying to say is that this is the after. This pro forma is we are projecting 2 years from now. In 2 years from now, at 6% appreciation, I believe this projection, although no one have a crystal ball, I don't have it either. It's just just a talking point, right? So at 6% annual appreciation, you bought this property at $385K. In 2 years, at 6% appreciation, the property will be valued at $440K, right? So you got some appreciation potential, and then your rent will catch up in about 2 years, from $2,500 to perhaps $2,750 rent, right? And then meanwhile, in the next 2 years, you're getting the other multi-dimension profits, such as loan pay down and equity buildup and increasing rental rates. So therefore, in about 2 years from now, with the lower interest rate of maybe 5%, guess what you're going to do? You're going to cash out refinance. When you cash out refinance at potentially a 5% interest rate 2 years from now, and then your revised monthly cash flow goes from $187 initially to approximately $412, right? I mean, you see how as a real estate investor, you have the ability to adapt and adjust to changing market conditions. So see, instead of people that are waiting in the sideline, people are too scared to take the plunge because of all the negative headlines, doom and gloom scenario. If you stay in the sideline, you cannot capture all these potential profit, the multi-dimensional profit associated with owning a rental property, right? So now you see, and then the action plan will be buy now, even at a current relatively high interest rate at 6% plus or minus. Enjoy the appreciation and cash flow accumulation, principal pay down, tax benefits, right? Get the slight cash flow, because you know what? I mean, if you have a long-term perspective, who cares about a couple of $100 cash flow? In fact, whether you have $200 monthly cash flow or $400 monthly cash flow, I mean, is this going to make a difference in your financial life right now, right? Because, depending on where you live, I mean, I live in San Francisco Bay Area, I could go out for dinner, for dinner for 2 people in a decent restaurant in San Francisco, and I would most likely have to pay $400 to $600, just like that. So, your financial life is not going to change just because you have a very small cash flow the first few years, right? Get in the game and allow the rental property to achieve the multi-dimensional effect of profit-making opportunities. And then when the rental rates catch up in 2 to 4 years, we feel strongly, and Justin can tell you, he knows his market, the rent will continue to increase. So 2 more slides, I'll be real quick. And people do not understand the rule of 72. What's the interest? The appreciation rate divided into 72, determine how many years your property will double in value. Let me give you an example of this property, right? The property, presumably, in this illustration, you bought it for $385K at 6% annual appreciation illustration. So 6% appreciation divided by 72. So your property will double in 12 years. So you bought it today at $385, and 12 years from now, $385 will become $700 $670,000. And then you add 12 more years, in 24 years, this 770K will double in value, compounding at $1.5 million. All right, so again, at the end of the day, as an investor, you need to ingrain this concept into your brain because this is so important. I'll repeat again, income property and rental property is history's most powerful and most proven, the most attractive, tax efficient, multi-dimensional real estate asset class in history. All right, so with that said, I'm gonna stop sharing. So Justin, can you provide your recap about what I just gone through?
Yeah, I mean, that was a great illustration of some of the points we've been talking about for, I don't know, a year and a half now. I mean, these are the goal of buying real estate, right? Is not, I'm going to buy it today and 1 year from now, I'm going to be rich and that'll be that and away I go. This is a long-term wealth building tool. And just like you showed, the amount of it's not the monthly income. It's not the amount of cash this property is going to generate. It's going to generate some, and that's great. And to make sure that you never spend any of your own money on maintenance, and that's great. You know, maybe you get to go to a nice dinner once a month because of it. And that's good. The real goal is that appreciation. It is that mortgage buy down, creating more equity paid for by someone else's money. That's where you create wealth, not just some extra money. And that's the key. You know, you showed, one of the things you showed, over time, you end up creating more and more money. So you could sell the property and capture that equity. One of the things we've talked about is, through us, we're a turnkey provider. We handle everything from the purchase to the management to the eventual sale. We've been managing a home for you for 12 years, 24 years. I can tell you your commissions paid on the closing aspect of it is going to be so small compared to what you should expect, right? We have told investors for a long time, if we're managing homes for years and years and years, we're not charging you full commission. Like I would charge someone who just comes to me today and says, hey, I want you to sell my home. We're gonna help you make even more money. And so imagine 24 years from now, you bought a property for $385. Your current balance on your mortgage is, off the top of my head, probably $70,000, maybe $60,000 at that point. It's worth $1.5 million, right? Instead of having to pay the 6% commission, you're paying 4, or you're paying 3.5, and you're keeping millions of dollars into your pocket. It would be over $1 million net at that point. And all you do is put $100,000 in 24 years ago. I mean, that is how you take money and create wealth, not just get some extra cash flow. That's the real goal here that we're trying to illustrate.
Yep, well said, Justin. So thank you for your input.